to CPA SkillNet Trainee Accountant webinar, and today I'm going to discuss the whole area of development land and capital gains tax. The whole area of development land and it cuts right across income tax. There's aspects of RCT you have to look at, but the big area that causes problems is the whole area of how to deal with it for capital gains tax. Now, when you're dealing with capital gains tax and development land, what you have to bear in mind is that a lot of land has two component values, and that's the current use value and the development value. Now, agricultural land, if you buy agricultural land and you sell agricultural land, the strong likelihood is you don't have to worry about these peculiar concepts for capital gains tax, mainly due to the reason because it is not development land. Well, if you just look at the two values, what's in a land has a current use value, and that's effectively the agricultural value, and development value, which is the add-on, which is the difference between market value and agricultural value. So an acre in Dublin could have an agricultural value of 5,000, but it could have development value of a few million. So that's why Revenue actually brought in some time ago rules dealing with how to handle development land. And the key area what they wanted to do is, what they wanted to catch was that they didn't want to give indexation relief on development value. Originally, when they brought in, they wanted to put a special rate on development land, and development land, the rate years ago was as high as 60%. Compare that to 20% there some years back, but it was as high as 60%. So the reason they took a special interest in development land was that it is sometimes difficult to see whether somebody is holding an asset as a capital asset or as a trading asset, and that's where the whole areas of badges of trade comes in. And so what we're looking at here would be what would happen if somebody was a developer or say somebody was just a speculator. Speculator, you're into the CGT sphere. Developer, you're more than likely into just purely the income tax or corporation tax sphere. So sometimes you might have to look at the badges of trade, which would actually could throw everything over into the income tax or income stream, which could be liable at 12.5%, or could be liable for the marginal rate of income tax plus levies, etc. For this session, what we're going to concentrate on just purely that it is held as a capital asset, as when you're talking either about speculators, or you could have a farmer who always had agricultural land and all of a sudden he or she is selling it to a builder, so it has a development value. So there's the two component parts: the current use value, which is effectively agricultural value, and the development value, which is just the difference between the two. The rules, and these are straightforward enough, but the standard rules on that is that when you're dealing with capital gains tax, it's only the current use value can be indexed. Now bear in mind, indexation was abolished in 2003, but for land that's been in the family for a long time, indexation is important. So only the current use value can be indexed, so only the agricultural value can be indexed. Development value cannot be indexed. Enhancement expenditure cannot be indexed. Another rule is that losses from other disposals cannot be offset against development land gains. So if you have losses arising from the sale of shares, well, those losses cannot be offset against development land gains. And the genesis of this goes back to when the rates for capital gains tax for development land was as high as 60%, and the rates, ordinary capital gains tax rates at the time probably was 30%. So you didn't want a loss with a loss from something that, if it had been a gain, would be taxed with only 30% being surrendered against something liable at 60%. But that's all in the past, but this explains where this stuff comes from. Enhancement expenditure, no, with land, enhancement expenditure, it normally refers to where they actually do major works on the land. pipe laying, etc. But it can include applying for and securing planning permission, and this is important. And I think this came up in the recent exam, so you'd have to know that enhancement expenditure includes securing planning permission. You'll also bear in mind that another key concept in dealing with capital gains tax, not just for development land, is that if somebody inherits an asset, the value of the asset that's taken is the value at date of death, not the value when the asset was secured for the individual. So if somebody dies in year one and due to probate issues, etc., the asset isn't secured until year 3, it's the value in year 1 you always take. That's a key concept for capital gains tax. So let's just take a simple one, and in this case here I'm just taking an indexation factor of 1.8. I'm just picking that out now, indexation factor of 1.8. And Tom purchases 10 acres of agricultural land in year 1 for 40,000, and it's just purely agricultural land. Tom applies for and secures planning permission that costs 6,000 in year 2, in year 3. And year 8, Tom sells all of the land for 700,000. And the costs of sale, that would be the auctioneers, or it could be solicitors' fees, etc., 55,000. Now, the first thing we note is that 55,000 will come off the 700,000. Just looking at it there, he purchased agricultural land, so there was no development value when he purchased it. It's 40,000. So what we're going to do here is, when we do the computation there, it's fairly straightforward. Sale price 700,000, cost 55,000, so the net sale price is 645,000. Cost, agricultural value only, that's all that was there when he got it. 40,000 by 1.8, 72,000. Enhancement expenditure. Now you'll see that here's one of the key rules kicking in. No indexation. I just shown one there just to show it, but no indexation. And that gives you an overall gain of 567,000. Now, this is something that came up in a recent exam. It's something similar to the question, and I believe this caused some difficulty. Just let's have a look at the example, and we'll get to some key concepts there. Paul inherits lands from his father in 1998. The value of the land at date of father's death was 200,000, but it had a current use value of 50,000. Now, this will all be based on the facts. Now, watch there. The key value, the key date is the father's death. The date of the land at the father's death, and what we have here is, it's based on the facts. There is a development value to the land, that whoever valued it for probate purposes, or valued it when it was handed over to Paul, they said, oh, this land has development value. And that's the question of fact, as I said. So therefore we have 200,000, current use value 50,000, development value 150,000. 1998, here comes the planning permission. So a few months later, planning permission costs incurred by Paul was 20,000. Now let's just stop here. If all the land was sold in one go, all we'd be looking at here would be looking at sale price less cost of sales, index 50,000, don't index the 150,000, and don't index the 20,000. But what's happening here is that Paul is actually selling it in a series of transactions. Now here's where we come to the difficulty caused by general difficulty in dealing with sales of land, in the sense that you see the two sites he's selling there in 1998, two sites for 40,000. Now we don't know from the question there how much land was, but let's say there was 10 acres. It's not simple enough to turn around and say, well listen, if 10 acres cost so much, 2 acres you just take 1/5 of it, or 20% of whatever the original cost. You cannot do that with land, and it's not that you cannot do it by law. It's just, if you just take about in common sense, if there was 10 acres here, you might have 8 acres up by a roadway, and you could have 2 acres down close to a bog or something like that, which wouldn't have much development value. So therefore you cannot just simply you buy land, or in this case inherit land, and say, well, if 10 acres cost so much, 1 acre, in this case 2 acres, cost 1 over 10 or 2 over 10. You cannot do that. And that's where you come into, you apply a formula which is called A over A plus B. We'll get to that in a second. So in 1998 he sold 2 sites for 40,000. Market value of remaining land was 425,000. Now, when we get to A over A plus B, the A in the formula will be 40,000 and the B will be 425. And that's how the formula works. So I get to the formula in a second. Then in 1999, another year later, he sells more sites for 270,000. And again, market value of remaining land was 415,000. And then 213, he sells the balance of the land for 750,000. Costs of sales. And that's the first time I've put in this example the cost of sales, but the cost of sales there 25,000. Okay, now our main problem, if you just look at this here, is that you're going to have we have 3 transactions. We have 1998, we have sale price 40,000, 1999 sale price 270,000, and 2013 sale price 750, in this case less 25,000 costs. But this is the question. For those 3 computations, how much of the 200,000, go to the first line there, how much of that 200,000 can be allocated against those sale proceeds in 1998, then in 1999, and then in 2013? How much can you allocate against it? And that's what causes the difficulty in it. Now, the formula for part disposal is A over A plus B. A over A plus B. A equals sale price. You ignore cost of sales. B is value of remaining asset. So let's have a look at this in an example. So the first disposal that took place, bear in mind, it cost 200,000. Cost, or that was the value when he inherited it, deemed cost. Development value was 150,000. Current use value, that's the agricultural value of the land, was 50,000, and enhancement was 20,000. Now, he sold the land in 1998, and he got 40,000 for it. Now, of that 40,000, of that land that was sold, how much of the 200,000 relates to it? And the way you work that is, you apply the formula. You take the 200,000 and you multiply it by A, which is the sale proceeds. You ignore costs of sales now. Sale proceeds over A, which is sale proceeds, plus value of remaining land. In other words, you could say that, you could recast that in another way. You could say, if you sold the land for 40,000, how much of what was the original cost of that land? And the original cost of that land was the original cost 200,000 by sale price over the total value of the land at the date of sale, which in this case is 40 plus 425. That's another way. Total value of the land at date of sale is another way of putting A plus B in the denominator. Okay, so that you work that right across, and that's 17,204, 12,903 development value. Again, 40 over 40 plus 425 for current use value. Apply that to 50,000, 4301. Enhancement then just gives you a portion of 1720. Now, what you end up doing the next disposal, which takes place in 1999, and you got 270 for that. Now this is the one where we just stop. Of the land that's been sold in 1999, of the original, this is the important bit, of the original cost of 200,000, the amount to be allocated against the remaining land is 182,796, 137,097, 45,699 and 18,280. So what the land is remaining after the 1998 sale is 182,796. Now he's only again part disposing of it, so he's getting 270,000. All the land doesn't go until 2013. So of the 182,796, again you apply your A over A plus B. A is 270. Again, watch, I'm not taking into account any cost of sales. I'm not giving it in the question anyway, but you don't take in cost of sales, so it's not the net proceeds you take into account. 270 over 270 plus 415. And that gives you 72050, and you work right across. And now, what are you left with? Well, the rest of the land is going to go in 2013. And for that rest of that land, its value, original cost value or base cost left is 110,746. And we get to the final computation, disposal in 2013, and you get 750,000 costs, 25,000 away from take that from us, that leaves you 725. What was left? Well, what was left, we'll just go back up to it. It was 82059, which was the development value, 82059, and 82059 is not indexed, so that's by 1. The current use value, go back to the current use value, was 27687, and I indexed that alright, and that gives me an indexation figure, in this case here from 1998 to 2013, 1.232. Now for an exam, you'd actually go to that will be given to you at the start of the exam, 1.232, 34110. Enhancement expenditure, back up again, look at it, 11075 is left. And this is all the part that was incurred, the original 20,000 for the getting the planning permission. That's left, and again that's not indexed. So that gives me a gain of 596,756. So they're just the mechanics as to how you untangle the base cost for the purpose of capital gains tax when you're dealing with development land. Now, just to remind you what I mentioned at the start is that Revenue watch this quite carefully, particularly if you look at the context where the capital gains tax rate was 20%, 25, and now it's up to 33. It still is a very, very good rate compared to the income tax rate, which with levies, etc., for a self-employed person can be up to 60%. So the danger in approaching this is that revenue might look at Paul in this example here and might say, well, look, let's put over the badges of trade onto Paul. And now the badges of trade, as you will remember, are the subject matter realization, which land can be either capital or revenue. It could be additional work on the assets since you acquired it. Well, enhancement expenditure would be additional work, but it wouldn't be extensive. In that the enhancement expenditure in this case here was just getting planning permission. History of dealing with similar sales of similar products or similar assets. Well, this is his third time now dealing with it, and he's creeping over closer to the line as to where from moving from capital gains tax treatment to income tax treatment. Length of period of ownership is another aspect of it. Length of period of ownership. Well, he's had it for a while, and that probably would not be indicative of an income tax treatment. So it'd be more helpful towards capital gains tax treatment. There's one or two aspects in the badges of trade, which is motive, etc. He didn't acquire the land with a purpose of what you would call in commercial terms of making a quick twist on it. He hasn't done extensive work on it. The more likely scenario here is that it will turn out to be regarded as capital transaction and therefore liable for capital gains tax treatment. Okay, so that's a run through the capital gains tax and treatment of development land, mainly giving you some of the specific rules for capital gains tax treatment, and running through an example of how you effectively untangle the base cost when you're dealing with a series of transactions. You untangle the base costs when you do a series of transactions. Okay, that's the end of the session. Thanks a lot.